We're joined by Reginald Kadzutu. He is the Chief Investment Officer at Amana Capital. Very welcome to the show, Mr. Kadzutu.
Thank you.
Now let's talk about the reasons behind this 10-year low. Some say it's reflecting investors' expectations of depressed earnings, possibly also in the banking sector. Some say foreign players are fleeing the market due to global factors. What's your take?
On the foreign players, it does play a part because most of the trades on the Nairobi Stock Exchange are actually done by foreigners. Whenever they come in to buy, the market goes up. Whenever they sell, the market goes down, which is a sad state when your stock exchange is run primarily by foreign investors. But we can look at it from two perspectives. If you look at it technically using a relative strength index, the market is at an oversold position, which means it's more of a bear market. But if you look at the charts and you follow the trend in the charts, I think we are in a cycle which might last close to a year or 2 years, remaining very bearish. The other angle you look at it is the Nairobi Stock Exchange is a reflection of the deteriorating economy over the years. Right. The last time we touched 5,000, I don't know, 2-3 years ago. And after that, it has been deteriorating, actually giving a reflection of what the economy looks like. Because when someone goes to buy a share or a stock, you are buying a potential income that is going to come, either dividend or capital growth that will come from that stock. Right. If the company is not going to perform very well, you will not expect very high dividends that are going to come from them, or even capital growth of the stock. So you'll find just generally because the economy is not doing well, it translates or is reflected by the Nairobi Stock Exchange.
Right, and then let's take a closer look at some of the worst performers, such as the insurance sector. The sector has actually, the stocks there have fallen 62% on average, and that's year to date. Give me a sense of the current state or the current realities in the sector. And as you're mentioning, those realities is what's translating to how investors are trading those stocks. So how long do you think this poor performance in the insurance sector is going to last?
It might last for a while as well, along with the drop in the Nairobi Stock Exchange.
Right.
If you look at the results for most insurance companies for 2018, most of them had higher claims than ever, especially on the medical side of it. And companies that had never run a loss, companies like Jubilee, ran losses for the first time because of higher claims. Then you also have write-offs that happened, for case in point Sanlam, because of bad investment decisions. They had to write off quite a number, sell buildings to try and compensate investors. And most insurance companies are heavily invested in the Nairobi Stock Exchange, and that's where they've been getting most of their return. So as long as the stock exchange is going to continue poor performing, they are holding positions that are carrying losses. So unless they realize their losses, put all the money in fixed income or government securities, we will expect their performance to also mirror the Nairobi Stock Exchange performance.
Right. Now, I pointed to the insurance sector because I thought the performance there was pretty dire. What are some of the worst performing sectors for you?
The banking sector has suffered a bit. If you notice the results for the banking sector, most of them are no longer doing double digits because of IFRS 9. Interest rate cap, so most of them are now just pumping all the money to the government. And if you notice equity bank results, loans grew up by 16%. So we might start seeing a trend where they will start again lending to the private sector because government securities are not giving them positive real returns. Right. Treasury bills are at 6.something%, inflation is around the same. So you're getting negative returns. Construction sector, we all know what's happening in the construction sector, which affects demand for cement from your bamburis. It's only one
Another
that is
worst
left.
Performance sector.
Exactly.
Construction.
Yeah, pretty much. So if you look at insurance, banking, construction, media, unfortunately, is also not doing well. Then they have to literally revitalize their business models because most organizations are moving to digital advertising, social media advertising, using influencers. They're no longer buying ad space on TV because people don't watch TV anymore or read newspapers. So that has been affecting their growth. And definitely, some of them had to write off payments from government, which have been stalling for quite some time.
Now, in light of this poor performance, we're going to see the half-year results rolling in pretty soon. What is your outlook? Is it, as cloudy as you're saying right now?
I don't see any stellar performance. The days of 30%, 40%, 20% growth are way gone. So investors need to temper their expectations. If you invest in a stock expecting 30, 20%, most of them do have some cash reserves, so they might be able to sustain their dividend payouts,
Right.
but not for another 12 months unless they completely start lending back to the private sector. Because the margins of lending to government and the interest rate cap, you'll find the operating margin, what you are making from the government and your operating expenditures, they end up making very thin margins of 1%, 2%
Right.
in a sector that was used to spreads of 10, 12%.
Right.
You're now reduced to try and fit all your cost in 2-3%. So I don't expect any stellar results, single digit at most, cost cutting. Most of them, that's how they're even reporting any profit, laying off stuff.
Right. Now, the NSE did just launch last month the derivatives market. How is that performing right now? Are we seeing a lot of activity there or a little activity? And also, it was meant to deepen liquidity in Nairobi Securities Exchange. Is it actually doing what it was meant to do?
I think things like derivatives, short selling are good things to just soothe the egos of the CEO and the chairman of the NSE.
Right.
Are they relevant for our market right now? No. When you have a market that's driven by foreigners, that means your institutional investors themselves are not investing in the stock market. Derivatives becomes, yeah, it's foreign. It won't perform well. It's just
Right.
like Mkiba and any other thing that NSE has tried to bring out. I think they need to focus more, spend more energy on how do you get people starting to trade more? How do you give institutional investors direct access to the market? And that's where you start seeing more liquidity.
Right.
Because if you reduce the transaction costs of trading on the NSE, you start seeing more trades. But before you purchase anything, you have to calculate how much return am I going to make vis-a-vis the transaction costs that come with it. Especially for retail investors, the transaction costs are just exorbitant because of having to go through brokers and all. So if they can give direct access to the market, things like that, invest more in investor education, then you start seeing more liquidity. But I don't think derivatives, who's going to short a stock that you actually know that the price is not going to move?
No interest right now.
Yeah, exactly.
Well, thank you so much for joining us in the studio. Thank you for your insights. Of course, that was Mr. Reginald Kadzutu. He is the Chief Investment Officer at Amana Capital.